Dr. C. Rangarajan has witnessed and chronicled over 4 decades of change in India, is possibly the best qualified person to give a view of India's story and its future. Ladies and gentlemen, please give a big hand together to Dr. Rangarajan.
Mr. Prabhu Chawla, distinguished bankers and other invitees. I'm indeed very happy to be here in your midst this evening. The best way to promote excellence in any field is to honor people of excellence in that field. And that is what we are doing today, this evening. May this event inspire the Indian banks to achieve higher and higher levels of excellence. In any economy, the financial sector plays a critical role in the mobilization and allocation of savings. Financial instruments, institutions, and markets constitute the financial sector of an economy. And it acts as a conduit for the transfer of resources from the net savers to the net borrowers. And in this process, it leads to the savings, both savings and investment, to reach higher levels. The impact on the real economy depends upon how efficiently this function of intermediation is performed by the financial sector. The Indian financial system comprises of an impressive network of banks and financial institutions and a wide range of financial instruments. There is no doubt that there has been a considerable widening and deepening of the financial system, particularly in the last 2 decades. The extension of financial services, more particularly banking, to a large cross-section of the people stands out as a significant achievement. As a ratio of GDP at current prices, bank deposits have increased from 18% in 1969-70 to 46.3% later by March 1995, and now stand at around 73%. Other financial indicators, such as the finance ratio or the interrelations ratio, have all increased, signifying the growing importance of financial institutions in the economy and the growth of the financial force in relation to the real economy. 1991 is an important landmark in the post-independent economic history of the country. The country faced an acute economic crisis triggered in part by a severe balance of payments problem. The crisis was converted into an opportunity to bring about some fundamental changes in the approach and content to India's economic policy. And the reforms in the financial sector were an integral part of the liberalization process. By dismantling the administered interest rate structure, by introducing prudential norms, by recapitalizing the public sector banks, and by injecting or by introducing a greater element of competition in the system, by the revamping of the financial system, and the introduction of an organized and a more rigorous supervisory and regulatory system, we have created a banking system that is more sound and more safe. The Indian banking system has emerged strong as a result of the reform measures introduced in the early 90s and continued since then. And this is particularly evidenced by the ability of the system to withstand the impact of the international financial crisis. However, as we move ahead, there are several challenges ahead, and I want to mention 3 of them. 1, capital adequacy. The Indian banking system remains well capitalized. The capital adequacy ratio for all scheduled commercial banks is now estimated at 14.7%, well above the required 9%. This high ratio means that the implementation of even the Basel III norms will not pose much difficulty, at least initially. However, it needs to be noted that the capital requirements consequent upon the introduction of the Basel III norms, as well as a growth in the demand for credit consistent with a growth rate in the economy of 8 to 9%, will require fairly large amount of capital to be injected. While the private sector will have to meet these requirements by accessing the capital market, the public sector banks will require additional budgetary support. Under the present dispensation, more than or nearly 50% of the additional capital requirement in the case of the public sector banks will have to come from the government. While several innovative suggestions have been made to raise this amount of capital, it is important to note that one estimate puts that the cumulative capital, additional capital required to be provided by the government at 1.5 lakhs of rupees to 1.75 lakhs of rupees for the period up to 31st March 2018. It is quite evident that the capital infusion by the government will remain large and has to be a continuous process, and as such, a long-term program of capital injection will have to be drawn up. Otherwise, the market share of the public sector banks will come down. The second, entry of new banks. If the Indian banking system is to remain competitive over time, there should be periodic entry of new banks. A closed system can only be oligopolistic. The threat of entry should not therefore be eliminated, and the central bank should lay down entry norms and also decide who satisfies the criterion of fit and proper. It must be noted that new banks take about 2 decades to achieve a sizable level. Our decision on how many new banks to be licensed must be based on what the economy needs, not today, but over the next several decades. Financial inclusion, a term which has become very popular, has many dimensions, and this has received much attention recently. First, it relates to bringing within the ambit of the financial sector the vulnerable sections of the society. Second, it means the expansion of the Indian banking system to provide services to all the sectors of the economy: agriculture, industry, and services. And third, it implies the extension of the organized banking system to all geographical regions. Thus, financial inclusion has social, sectoral, and regional dimensions. However, the term financial inclusion has largely been used in the context of reaching out to the bottom deciles of population in terms of provision of deposits and credit. Thus, it has an equitable growth element in it. However, as the economy grows, we must take into account all the 3 dimensions of inclusiveness, and a strong and viable banking system must take care of all the segments of the economy. I would like to refer to one other aspect, and that is on the relationship between regulation and innovation. As I mentioned at the beginning, the development of the financial system is considered crucial to sustaining high economic growth. However, in the wake of the recent international financial crisis, some questions have been raised about whether the unfettered development of the financial markets and products is good for the economy. It has been argued that not all financial innovations are welfare maximizing. Thus, the recent financial crisis has forced us to reevaluate the size, role, and rate of growth of the financial sector. Banking development has taken big strides in the last 2 decades. The basic motivation for inducting new financial products is to improve customer satisfaction. The question that has been raised or is being asked increasingly is whether the financial sector today is inherently more volatile and vulnerable than before. The very factors that have contributed to the growth of the financial sector may well have contributed to increase its fragility. Close interdependence among markets and market participants have increased the potential for adverse events to spread quickly. They have increased significantly the scope for and speed of contagion. Some question whether the new financial products serve any socially useful purpose. The Stiglitz Commission said, and I quote, "Much of the recent innovation in the financial system has sought to increase the short-term profitability of the financial sector rather than to increase the ability of the financial markets to better perform their essential functions of managing risks and allocating capital." In addition, innovation has engendered financial instability. Indeed, from the point of view of the economy as a whole, some innovations had clearly a negative impact. End quote. It would be inappropriate, in my view, to classify all or even most of the financial innovations introduced in the last few decades as socially unproductive. Many of the financial products satisfy a felt need. We are living in a world of uncertainty. Customers need to protect themselves from the volatility in exchange rate and interest rate. Appropriate hedging mechanisms are therefore needed. It is the function of an efficiently operating financial system to provide these instruments. It is wrong to argue that the economic growth seen by the industrially advanced countries in the recent period has not been helped by the improvements in the financial markets. But excesses in any field have their own dangers. There is no argument that the regulatory regime needs to be restructured. This is true particularly of the developed countries, to make the banking system more sound. Excessive risk-taking and leveraging by banks need to be discouraged by appropriate regulatory measures or controls. Of course, there is a larger question whether the financial sector is growing at a rate disproportionate to the growth of the real sector. But to set the face against financial innovation is not a wise policy. In developing economies like India, the structure of the economy is undergoing a rapid change. The financial system must be able to meet the diversified needs of a growing economy. In this context, we must actually encourage financial innovations. For example, in the Indian context, I would like to cite 2 instances. First, there is a need to encourage the emergence of a vibrant corporate debt market. Efficient debt market will help not only large industries, but also small and medium enterprises. A number of suggestions have been made to create an efficient debt market in our country. Apart from other things, I feel we also need institutions which will serve as market makers, offering two-way quotes. This will provide the needed liquidity to the market and make it attractive to the investors. Second, there is a need to explore innovative ways of financing infrastructure. Banks at present have certain limitations. They have to take care of the mismatch in liability and asset management. Of course, a vibrant debt market will also help investors' need for long-term funding. Takeout financing has been suggested as one way by which the tenure of loan can be increased. Thus, the scope for financial innovation continues to remain wide in India. We need to draw appropriate lessons from the international financial crisis. Too little regulation may encourage financial instability, but too much of it can impede financial innovations which are badly needed. Regulatory oversight of innovation is necessary, but the regulatory perspective on innovation must not become too restrictive. In short, the policymakers must strike an appropriate balance between the need for financial innovations to sustain growth and the need for regulation to ensure stability. Financial innovations and regulations must go hand in hand in order to ensure growth with stability both in the real and the financial sectors. To conclude, in many ways, the coming decade will be critical for India. Only if India grows between 8 to 9%, it is possible that the per capita GDP will increase from the current level of $1,600 to $8,000 to $10,000 by 2025. Then only India will transit from being a low-income country into a middle-income country. For this to happen, the Indian banking system must develop in order to meet the needs of a growing and diversifying economy and assist in the process of transition. A competitive environment is essential to make the banking system cost efficient. Adequate availability of services to customers, both as depositors and borrowers, must remain as the driving force. Obviously, regulation is important to steer the banking system towards prudence and stability. But within the regulatory umbrella, we must nurture a competitive environment and which will alone enable the services to be delivered at a minimal cost. I think these are some of the things that I wanted to say. Thank you very much.